Okay, and in this video we're going to look at the use of free cash flow and evaluating a company's cash flow. So let me quickly get to that slide. So free cash flow measures the company's operating cash flow available to use for purchasing property, plant, and equipment necessary to maintain its current operations. And property, plant, and equipment is referred to as PP&E. Since the investments in PP&E necessary to maintain the current operations cannot often be determined from financial statements, analysts estimate this amount using the cash used to purchase PP&E as shown in the statement of cash flows. Okay, so we have net cash flow from operating activities, and then we have less the cash purchase for PP&E, and that gets us to our free cash flow. They will also look at this as a ratio, which is just a ratio of sales. So you say free cash flow divided by sales. So if you have a positive free cash flow, that's considered favorable. A company that has free cash flow is able to fund growth and acquisition, which means they can buy new things. They can retire their debt, which means they can pay off their liabilities. They can purchase treasury stock when they want to, and they can pay dividends. A company with no free cash flow may have limited financial flexibility, and it could lead to liquidity problems, which means they might not be able to pay their obligations. So work this example exercise and then check your work, and let me know if you have any questions.